Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. We're in the danger zone for inflation. Base effects are automatically pushing up annual inflation rates, and there are many signs of supply constraints. The challenge is to work out whether this will be temporary or permanent. To help clarify the picture, we published two important pieces this week. One looks at whether global factors rather than local factors are driving core inflation in the major economies, and the other looks at how labor supply issues could alter the growth profile this year, away from what consensus is expecting. You can access these pieces by becoming a member of Macro Hive at macrohive.com. On top of that, you'll get access to our archive of research notes, as well as being able to access our member Slack room, where the Macro Hive team and members have a healthy discussion on markets. And this is quite different from what you see on Twitter. When you sign up, the first month is free, and then it's only the cost of a few weekly cappuccinos. It's well worth it, and many call Macro Hive the hidden gem for investors. So once again, sign up at macrohive.com. Now, on to this episode's guest, Phil Suttle. Phil is one of my favorite global economists. Currently, he runs his own economic research outfit called Suttle Economics. Before that, he worked at JPMorgan, the Fed, the World Bank, Barclays and Tudor. And in this episode, we have an excellent discussion on the ins and outs of the inflation outlook, as well as the growth outlook for the major economies. So, on to our conversation. So welcome, Phil. Welcome back to the podcast. I think we had you on almost a year ago, and I'm trying to remember what we talked about. And I'm sure everything you said has turned out to be correct. But anyway, welcome back.
Thanks, Bilal.
Okay. When I last had you on, I forgot to ask you your origin story. You know, what did you study at university? Was it inevitable that you were going to become a researcher? I mean, where did you start, and how did you end up where you are today?
Interesting. So I guess sad to say I'm one of these sort of really boring people that always wanted to do sort of economics and finance. Although I think actually when I started out at high school in England, I swear I'm the only 13-year-old that went out and bought Accountancy Made Simple as a book. There were many other books I should have been reading, but instead I bought, and I did actually, because my dad was an accountant or a bookkeeper, and I did want to be an accountant. But I guess there's that old joke about economists being people who are good at figures but don't have the charisma to become accountants. And in a way, I ended up sort of degenerating down the scale into being an economist. So I did that through A-levels, and I was very keen on that, and then did it at university, did history and economics at university, which was as much economics as I could do. So I had to do some history, which I was very glad actually, because I think history is a really important kind of subtext for an economist to have, you know, a sense of perspective. But basically I ended up going through the sort of usual channels after University of Bank of England. And then I was lucky enough to be poached by JPMorgan during the Big Bang period in London in the mid-80s. And I think that's lucky because a lot of the people I actually literally used to sit opposite Andrew Bailey. So he, you know, I'm not suggesting if I hadn't left the bank, it would have been me in that seat rather than him. But it's interesting to sort of see where my peer group went. But I think I benefited from going out to work at JPMorgan because that was a fantastic institution to get developed at. And I guess for you, that's where we first met. But really for the rest of my career, I sort of alternated between the private and the public sectors, or between sort of policy type job and private jobs. And that has also been a really helpful input into what I do, because I think to have that sort of sense of balance of the way markets work and the way economies work, which you tend to get kicked into you a bit more in the private sector, but also the sort of perspective on where policymakers are coming from. That's very useful. So I worked at the Bank of England. I worked at the New York Fed briefly, mainly because of 9/11, which caused me to think twice about working downtown after the tragedy. Then also worked at the World Bank. And then the final little thing I've done, apart from, you know, a few private sector jobs with Morgan, Barclays and with the hedge fund Tudor. The other thing I did, which I thought was really interesting, was I worked for this bank industry group called the Institute of International Finance, where I was chief economist for about 7 years in the aftermath of the financial crisis, during the Euro crisis and the sovereign debt stuff in Europe. And that was really interesting because, again, it got me very close to the policy world, but from an angle of the private sector, if you see what I mean. And I was able to see some of the sort of botch-ups that the public sector was doing at the time. And that, I think, gives me a decent perspective for some sense of where we stand today on policy. Because I think, if I can summarize it very briefly, before the financial crisis in 08, 09, the private sector thought it knew everything. And the public sector was quite, in a funny sense, quite sort of humble and always willing to sort of defer. And now I think sort of after 2009-10, there's been a little bit of an inversion, and the private sector sort of views itself as a sort of taker of whatever has to happen. And the public sector views itself as very omniscient and very able to, get it right and be very confident that it's got it right. Even when it gets it wrong, it's still very confident that it's going to get it right. If you see what I mean? And I think that guides me a lot. I know we'll talk about inflation, but that guides me a lot in my thinking about some of the errors that we may be making on inflation.
Well, perhaps we can start with that. There's kind of a lot of debate amongst investors and economists about the path of inflation. Now, of course, we've been almost kind of programmed to think that we can't really see a resurgence of inflation because there's been so many false dawns for inflation. Yet at the same time, commodity prices are shooting higher. A lot of the PPI type measures and wholesale price measures are going up. What's your take on all of this then at the moment?
Yeah, I mean, well, first of all, obviously, there isn't a single global story because different conditions prevail in different countries. And one of the things that's happened in my career, which is very impressive, is the degree of global inflation convergence on a low level, and especially not all emerging economies, but many emerging economies that had horrifically high inflation rates. Most of my career have now converged on sort of OECD single digit rates, et cetera, et cetera. So that's an important point to make. But I think to me, my takeaway is that, well, first of all, it's a little frustrating because for many, many years, we sort of thought we had a very strong model of inflation. Changed a bit, but we always felt confident in our model. So in the 70s and 80s, it was more a monetary-based model. And then in the 90s and 2000s, it was more sort of a slack or output gap or unemployment rate type, Phillips curve type model. And I think what's happened in the last few years is we've sort of lost our faith in any single inflation model, such that it's almost now the case, I would say, that it's not clear we have a model of inflation, and it's almost like a religion now. You either believe it's going to go up or you believe it's going to stay stable. When you sort of dig into why people have those beliefs, they don't have a great deal of clear articulation, in my view. So I think that's an important point about the inflation process. And I think that feeds into a very important notion, which is that inflation is inherently a very sticky process. So for most of us who came into this sort of world in a career in the sort of 70s, 80s, and early 90s, we were used to a sort of sticky high level of inflation. So our bias was to think, well, here we are at a low level, but it's got to go back up because, that's sort of the way the world works. And I think now, after 20 years, 25 years of low inflation across most of the DM economies, especially the US, we're in the opposite situation where there's a huge amount of inertia keeping prices low and relatively stable. In Japan, that inertia actually turned negative for 20 years, and maybe now it's become positive again. But everywhere, I think we've got this real sense of low inflation inertia. So that's my starting point. It's going to be hard to get inflation up. However, I think inflation is primarily driven by the sense of the matching of aggregate demand and aggregate supply. And, that's true across a broad set of markets, which is what inflation is all about, a broad increase in the price level or a broad development in the price level. And I think the conditions we're now seeing are very different from anything we've seen realistically since the early 1970s, which are a very broad increase in aggregate demand, especially in the United States, and especially in the goods producing sectors of the economy, against the backdrop of a supply side that I think is becoming less flexible than it was for much of the last 20 years. And some of that's a COVID story, the dislocations of COVID. Some of it is a China story, meaning, the supply effect of China suddenly opening up to the rest of the world and Eastern Europe, etc. That's fading. And in fact, China's going the other way. It wants to consume not supply. And then the final point, which is what Charles Goodhart and his colleague have been emphasizing, is the sort of demographic story. The only point I'd sort of throw in as a sort of counterweight to this message that, we are, I think, in a generalized phase of accelerating inflation led by aggregate demand, excess aggregate demand. The only thing I'd throw in aside from this point about inertia is that one of the propagation mechanisms through the 60s that was very powerful was the, putting it bluntly, the trade union movement and the tendency for wages and prices to spiral up together. And that doesn't seem to be there. And I'm tempted to say yet, but I think also it's an institutional change that's kind of left labour markets lagging. So there's a tendency in most inflation thinking to look to wages as the initial sort of driver of inflation. I'd say in this process, they're more likely to be the laggard and go up once other prices go up.
Yeah. And you mentioned, lots of these sort of supply-demand mismatches are most prevalent in the goods sector, yet CPI measures or the economies in the richer economies, they're predominantly services. So, how do you map this to the service sector?
Well, one way of thinking about the inflation process is that the sharp end, as I like to call it, is all about goods. So whenever you've had inflation in the past, most of the movement comes in the goods area, and not just inflation but deflation. So the disinflation process is led by goods, and services tend to be more muted. So in a sense, maybe I can put some numbers on it to give a little more clarity. I think US inflation is headed above 3% over, let's call it the sort of 22-25 period.
That's noticeably higher than consensus and the Fed and most sort of projections, I think.
Yeah, it's a funny view to have in a way, because you could say, well, if you go above 3, you're almost certain to go above 4, and why stop at 3? But I'm giving you, in some sense, a probability-weighted sort of expected value, rather than this idea that we're inevitably going to sort of trend back to 1 3/4 or 2. And my thinking there is that really what's going to happen is that service inflation, which has been typically around 3% for the last 20 years, will continue at that level, if not maybe a little bit stronger. But what's really going to change is that this goods price stability phenomenon that we've had in the United States for the last 20 years will change for a while. And instead, goods pricing will join service pricing in the sort of, let's call it the 3% range to make life easy. And, that wouldn't be unusual by historic standards. It would be unusual by the last 20 years. But as I say, many of the forces that I think I described earlier are pointing towards a sustained acceleration in goods pricing. And it's probably goods pricing that tends to be the one that expectations become a little more important in the short run. So in the 80s and 90s, when we were still dealing with the disinflation process, many Wall Street economists used to talk about pricing power. And I don't hear that phrase very much anymore. And I think one of the reasons for it is that many companies sort of saw themselves in the 80s and 90s as sort of operating inherently in sort of monopsonistic or monopolistic markets, meaning there was a sense in which, the demand curves they faced were downward sloping. They weren't perfectly elastic. Then I think in the last 10, 15 years, there was this notion that many companies felt themselves almost like they were perfect competitors, operating in a very flexible environment where they basically had no pricing power. You set the price of what the market would bear. And I think the way I would look at the next few years is I think we're moving back towards a world where more companies will perceive themselves to have a little bit more pricing power. And once that process gets underway, that's all part of the sort of ratcheting up of expectations.
And the factors that you mentioned that would drive goods prices higher, COVID, deglobalization, China, and then also demographics, presumably that should also apply to Western Europe as well. So the Euro area or even Japan as well. So the reason I ask is if I think about sort of the balance of risks, there is a sort of vocal part of the market that is looking for higher inflation in the US, but no one really expects anything for Euro area, nor do they expect much for Japan. But could these forces affect those economies as well?
Yes, putting it bluntly, yes, partly because the goods markets tend to be globally integrated. And more importantly, there's the last 20, 30, 40 years has been all about, I think, sort of a correlation of of movements in inflation trends across the major economies. So yes, there will be spillover. I just feel, the Anglo economies, the English-speaking economies, let's call them, have a little bit more of a propensity to this inflation phenomenon than will the Europeans and Japan. The reason, I'm one of these people that feels the euro area is inherently a very flawed system, will struggle to hold itself together for an extended period, has struggled and will continue to struggle. So, we're in a brighter period now, perhaps, when COVID goes away. But I worry that Europe's kind of got this deflationary bias because it's a system that doesn't work naturally from a growth perspective. Japan has a demographic problem. You could say, well, of course, if I'm going to follow the good hard argument on demographics, it should be pushing inflation there up. But, I think it also has a sluggish growth phenomenon and just a lot of inertia there. I think what's interesting to me about Japan is that the BOJ is clearly already the first central bank to effectively abandon a 2% inflation aspiration. They've signaled they'll be happy with ending deflation, and 0 to 1 is enough for them. That's actually what they've been effectively saying for the last few months in their actions and their forecasts. The final point I make about the euro area is I think you have this inherent dilemma that the Germans still sort of, in some sense, run the system, and they don't want inflation much above 2. So to get Europe working properly, you need strong regions and weak regions, and you need Germany to probably have a structurally higher than 2% inflation rate for the region to average 2 to help correct the secular trends towards imbalance within the region.
And then if we move back to the US, I know you sort of track, all kind of the usual sort of indicators and data points as well as much more. What signs do you see currently of high inflation?
Well, the problem with the US at the moment is that the near-term inflation pressures are so rampant that it's hard to get a clear signal on where we actually are. And what I mean by that is that not only are we seeing very significant price increases in goods across the board, as well as many services like airline fares, etc., but we're also seeing incredible shortages develop. Now, you could say, well, some of that's just because some sectors are super hot, like construction. So anyone trying to build a house, as I am at the moment, or renovate a house, is finding that you're being told that not only is the price of materials 3 times what it was a year ago, but if you order it today, you'll get it in October or you'll get it in December. And I think that, it's the combination of actual price increases with the sense of shortage across the economy that I think is to me, the most striking. It's why I compare the current period with the early 1970s. The buoyant inflation that we had in the 80s and the early 90s is nothing like what we have now. And incidentally, if I'm flagging growth risks in the United States in the near term, there aren't actually many on the downside, but the one I think that I worry about the most is simply an inability to produce, shortages. You're already seeing it in the manufacturing sector with the auto sector struggling to get cars out the door simply because the inputs aren't available, the components aren't available.
And these shortages makes me think, is it just a temporary phenomenon related to just the economy reopening, that 3-6 months you get through all these bottlenecks and then the shortage problems will be gone? Or is there something more permanent, do you think? This is to do with the new structure of the economy or something?
Yeah, I think that's why I said earlier that it's a bit hard to make a longer term judgment because there's so much rampant near-term that it's a little hard to extract signal from noise, if you see what I mean. And I think in that sense, my guess would be that the way some of this gets resolved is delays get reduced by prices going up to choke off demand, as it were. So demand is sufficiently strong that it will continue to push prices up. So there's sort of both effects in play. Give you a little bit of an illustration in the manufacturing sector. I mentioned earlier autos. One of the ways that manufacturing got itself profitable and strong through the 90s and 2000s was to go to a very low operating level for inventory. Now, I think what COVID has done and some of the dislocations related to COVID, and that includes some of the international trade problems we now have with shortages of ships and containers and ports. Some of those things I think are going to lead to a more quite possibly a secular rise in inventory levels again. So the just-in-time approach is going to become, well, maybe just in a bit more time. We'll have a little bit. And it's hard to model or project how those forces will play out in terms of months and quarters and years. But to me, it looks more of a secular development. In other words, a step change in behavior rather than a very short-term indigestion problem.
Yeah, that makes sense. And so what's your sense on the US growth profile for this year? So when I look at consensus, Q2, our current quarter, and Q3, you're going to see a fairly healthy clip of growth. And then Q4, it starts to go lower. And then next year, you kind of head back towards kind of trend growth, you could say. How are you looking at the sort of the profile?
So I'm probably a bit more, a similar profile, but a bit more optimistic. I'm not sure, a bit higher numbers. My forecast for a few months now has been for the US for 8% Q4 on Q4. And then for 2022, about 4% Q4 on Q4. So the real message there is us above trend growth still into next year. I think trend is rising, by the way. And that, one of the reasons for that is that one of the reasons for my growth view is that I'm expecting strong investment in the next 2 or 3 years.
Is that due to the fiscal side, or is that something else?
The fiscal side is helping, perhaps. But the main driver is what I think of as a change in private sector behavior. And again, maybe this is too grand a way of thinking about it, but I think this expansion, the private sector will change its behavior to being more based around, the acquisition of real assets rather than the de facto acquisition of financial assets, i.e. stock. I think companies will see more of a desire and an interest and an incentive, all these things. It'll be seen as the cool thing to do will be to invest in expansion rather than in buying back your stock to buoy up the equity price.
Yeah, that makes sense. I mean, are we seeing signs of that already, would you say? The investment side, yeah.
I think we are. I mean, I think we're seeing it in two ways. One is we're actually seeing a lot of investment, which I think is you could say, well, who knows what's really driving it. But for now, the fact that investment has been so strong through the recession and in the early quarters of the expansion is very encouraging. So I think the real asset, the incentive to sort of become more based around investment rather than buying back stock, first of all, it's already happening. You're seeing it in the hard data. But I think, for much of the past decade or so, there's been a sort of bit of a paranoia in corporate boardrooms that if we were the only ones to do the investment and everyone else starts buying back stock, keeps buying back stock, we're going to get fired or whatever. And I think the best example of that was GE. GE tried to use the last expansion to build a real company and expand its real company and end up dramatically underperforming others, and it was Immelt's last decade was a disaster. So I think where we are now is that the past year and a half or so, the past year has seen a phase where companies have actually cut back dramatically buybacks, often because they had to, and it hasn't hurt their stock. There hasn't. And now there's more of a sense. I mean, look at some of the sort of recent stock market behavior. I think, there's more of a hope and expectation from growth. Companies are being rewarded for promising growth rather than for promising, returning cash to shareholders.
I mean, what's the business cycle implications of an investment-led cycle?
Yeah, I mean, in a way, I think they're fairly straightforward, which is that we're going to see higher trend growth, higher, therefore, perceptions of, well, I hate to use this term, but the equilibrium real interest rate, our star. And therefore, because I think you can make anything an equilibrium if you try hard enough. That's what we were able to do in the past decade. But therefore, probably, a higher perception of where policy interest rates can go through this next expansion. So it becomes a bit more of a virtuous circle. Dare I say it, more like the conditions we had prevailing in the 1990s.
And I mean, what does this mean then for the Fed? Because, I suppose there's an expectation the Fed will start to taper early next year and then may hike probably the year after, 2023 at the earliest. And that's kind of the current perception, I suppose. I mean, would you kind of agree with that? Or
Well, I think the Fed will be in play earlier than that. I mean, there's two issues. One is what the market sort of prices for the Fed and, how market thinking about the Fed changes, and then how the Fed itself changes. And I'm fairly convinced, and I think this is obviously everyone would agree with this, I think that the market's more likely to lead the Fed than the Fed leading the market. I think the Fed's made it very clear, the Powell Fed has made it very clear that unless something very dramatic happens, inflation spikes to 4 or 5%, the Fed is going to be patient and slow in adjusting rates. But I think what the market will do is it will see these evolving conditions of solid growth, inflation going to 3% and staying there, not going to 3% and coming down. And I think the market will then begin to adjust up its expectations for policy rates and for the medium-term sort of outlook for R-star. On the near-term tactics for the Fed, I'm fairly convinced that, they'll keep going with their current QE policy through the end of this year, but basically taper during Q4. So they'll announce that at Jackson Hole. It'll be a very sort of ponderous process, but Jackson Hole will be the sort of period where they say, it looks like sufficient progress has been made that we can take this action. I'm also of the view that the easy way to taper is to cut the mortgage-backed securities purchases because they are clearly buoying up. I mean, they were introduced in 2010 because the Fed could do it, and it needed to do it in that sector because the housing market was the epicenter of the problem. Now the housing market's at the other extreme. It's at the epicenter of the overheating. So to goose up the housing market further with MBS purchases, in my view, is just irresponsible, personally. I really think. And I saw John Williams yesterday, heard John Williams give a defense of it, saying, buying mortgages, it spreads to other spread products, and those are the ones we really want to affect, and that's all good. And I think that was a very lame explanation that doesn't, and when I saw Powell being questioned on this in the last question of the last press conference, I think his defense was also a pretty weak one. So I think it's kind of becoming clear to them that is not a good QE approach to have, and it would be relatively easy and costless and very undisruptive to the market to scale back on that. So I think we end up ending the year with monthly purchases of 80 billion treasuries extending into 2022, and then those get gradually scaled back as we go through the first half of 22. And I see the first rate hike coming at some point in Q4 22. A slight complication there is that, we have the midterms in November 22. So that makes the December 22 meeting an obvious one, but maybe they do it before then. Maybe they do it in September.
And I mean, how does this all fit into the new Fed framework, the average inflation targeting? How serious are they about this new framework?
Well, I think they're fairly serious in the next year about it, meaning when inflation goes above 3 or goes to 3, they won't do anything. I mean, I think when they were first talking about an inflation overshoot, there was a lot of suggestion that 2.5 was the upper limit. Now I think having gone to the inflation averaging concept and having had inflation averaging, 1 3/4 for the last decade, in a sense, you're comparing two integrals, two areas, the relatively long but shallow undershoot to a overshoot phase, which you can now afford to be relatively steep, but hopefully not very long, if you see what I mean. And you're trying to match those two areas visually. I think the problem that the Fed will have is, if I'm right, I mean, their current thinking and their current mantra is inflation will go up to 2 plus, 2.5, 2 3/4, and then come down again. And it'll come down again by the end of the year. And if that's wrong, by the end of 21 into early 22, if that view is wrong, which I think it will be shown to be wrong, that's when they have to sort of begin to be quite a bit more cautious, I think.
Yeah. And in terms of downside risk to growth, what are you most worried about? Like what types of things? I mean, one is the supply issues, I suppose, is kind of an immediate one.
Yeah. In the near term, I think that's very relevant. I think looking further out, I think there are sort of two related topics or two related areas. One is the fiscal dynamic, and we've seen such a massive easing in fiscal policy really over the last year and a quarter now, but it's come in several waves, and the latest obviously came at the start of this year, January and March. So we're a bit uncertain. I think we're flying a bit blind on episodes to try and understand when you take away new support, how that plays out. Should that be viewed as a fiscal tightening, or how much pent-up demand is there still in the system from the stuff that already got dispersed, that's gone into savings, etc. So that's an issue. And I think even more important is the political dynamic. I mentioned earlier the midterms, but really starting this summer onwards, you've got a potential for quite a heated political environment on fiscal policy. The debt ceiling comes back into force on August 1st. Who knows what the Republicans will do when it comes to threatening to block its increase or whatever. Notionally, they don't have the ability to do that, but they can be difficult about things. More important than that, even, you could say there's the whole Biden budget for fiscal year 22, which has to get passed. And he wants to enact a major shift in relative spending priorities away from defense to non-defense. And that's bound to produce, even within some of the Democrat Party votes, that's bound to produce some tensions. So it's the fiscal policy issue that worries me. And of course, that was really severe in 2011, 12, and 13. And one of the reasons why the last expansion fell over quite quickly. And I think then following on from that is the risk of some kind of market correction, some kind of asset price problem, whether in stocks or bonds or both. More likely it's both, that could come from a sense of the market beginning to panic about higher inflation, higher bond yields, lower stocks, and a sort of unraveling of the great bull market. So that, I think, that to me is and in a sense, the inability, if inflation really is going up, the inability of policymakers to credibly do anything about it. Because it would be very hard for the Fed to say, don't worry, we'll be able to suppress bond yields by printing even more money if it's the money printing that by that time the market is worried about.
Yeah. I mean, I guess one thing that has been debated at least in academic circles, is the whole notion of COVID scarring. I mean, do you subscribe to that? That there will be some scarring, just in the same way as after the global financial crisis, there was kind of scarring, you could say. There'll be something similar after COVID.
Yeah, I think the problem with scarring is it's sort of not a helpful image. I think there's two issues to think about. One is how the supply side might change given some of the effects that COVID will have on behavior. We've already talked about some of those with inventory dislocations. So those are potentially more durable. I think the other thing that's kind of puzzling to me, I'm not sure if I call it scarring or what it is, but where we are now, just take a look at a picture of US consumption spending over the last year and a half. And what you see is goods spending, about 15% above its pre-crisis trend. And obviously, kind of as the mirror image of that, services spending about 7 or 8% below. So in some sense, good consumption has recovered, consumption has normalized, but the pattern of consumption today remains very different from where it was a year and a half ago. And obviously that suited a lot of businesses and killed many others. And I think what I'm trying to get my mind around is how durable will that relative shift be? And of course, some of what we've talked about, which is the inflation process, tends to work against the durability, meaning the price of goods goes up, and it will encourage people to kind of buy less of them, if you see what I mean. And so I think one of the things that will happen over the next year and a half, couple of years, which has been less appreciated perhaps by the market, especially by equity analysts, is that there's some potential that we can end up with something that looks almost like a recession in some goods areas, even as we get booms in services areas, because you normalize the relative basket of consumption, as it were. And I don't think that's been fully factored into thinking. Now, coming back to your scarring point, maybe that doesn't happen and we stay where we are, in which case that is a scarring event, if you see what I mean. So it's, I think, one of the big issues in my mind about COVID and the whole events of the last year and a half is how some of these relative shifts, not absolute, but how some of these relative shifts play out over the next 2-3 years.
Yeah, that makes sense. Now, if we move outside of the US, I mean, what's your view on China at the moment?
Boring. No, I mean, seriously, I think China's now, well ahead of its expansion, well ahead of its cycle than the rest of the world, and now settling down to something that, I think the policymakers are happy with, which is sort of slow, steady growth by Chinese standards. Nothing too exciting. I mentioned earlier that I think China's going from being a sort of provider of goods to the rest of the world to being more of a taker or less of a provider, let's say. And I think from that sense, China's sort of less of a, but adds a little more inflation to the world, but not because it itself is growing rapidly. But I think it's, commodity demands will remain very robust, but they probably peaked, put it that way.
Yeah. Okay. Yeah. And do you have any views on any other, EM economies?
Well, I've been sort of thumping the table a bit on the risks associated with EM, mainly in local debt markets. I mean, we've talked a little bit about the sort of potential for financial disruption from a normalization of Fed rates, but I think there's much more mispricing of short rates in key emerging economies. We don't have a lot of examples of how that might play out. Turkey is obviously one illustration. Brazil's looking similar to, not similar, but Brazil's now entering a phase of much more aggressive rate hikes, normalization than was expected 6 months ago. And I think that process will roll through many of the emerging economies, especially Latin America, but also in South Africa and East Asia as well. Many of the lower income countries, middle income countries in East Asia, I think, have quite vulnerable short rate structures.
Yeah. And one just bigger picture thing we've been thinking about, or I've been thinking about, is the whole climate change agenda and how that impacts policy and the economy. So there's this idea that, especially now with the Biden administration, now we'll see a more concerted effort for a reorientation of infrastructure spending and green policies and so on. And that potentially could lead to, the growth of new sectors in the economy, which is growth positive. At the same time, it could be more inflationary as well, because you're introducing kind of a new cost to everything. I mean, how do you first, just from a framework perspective, think about climate change policies? And then the other side is, what do you think is the probability of these things happening?
Well, I think, glad you brought it up, because it has been one of these important changes that's occurred over the last year and a half, especially with the Biden administration, as you say. And you can see that sort of Biden's lift to sort of the alternative energy sector has kind of given confidence to other governments that were perhaps kind of keeping their heads a bit lower on some of these issues under Trump. And, there's a question of how durable the US shift will be. I mean, if we get, if the midterms then end up with a Republican win and, we go back to a Republican president in 2024, the agenda may shift back a little bit. But I'm assuming it's a more durable shift. And I think you nailed it when you said, well, first of all, this is probably going to be good for growth and investment. It's one of the paradoxes that a lot of, in the US, a lot of those resisting the climate change discussion sort of say, well, it would hurt the economy. In fact, my take is somewhat the opposite. But having said that, I think the way I think about the inflation effects of this is that we've effectively underpriced energy for the last, especially the last 20, 30 years. We've taken carbon for granted, our ability to generate carbon for granted. And that's been a big part of this. Why have goods been so cheap and plentiful? Well, no one's cared about the damaging effects of producing so many goods. Now people are, and they'll need to price it into some form of system that pushes up the costs of goods production and obviously services as well, but especially goods production. And that's going to get reflected again in higher goods pricing. It's a good thing in some ways because it means that the price signals are out there to affect behavior, but it's going to have this macro effect on the numbers.
Yeah. And the last question I want to ask is that you're a Brit living in the US, so it's interesting to hear your take on the UK.
Well, I feel very sad because I think the UK has been in this sort of secular decline mode for well over 100 years now, but was able to interrupt it starting at some point in the late 70s, early 80s. And I'm not giving Margaret Thatcher too much credit, but I think she was part of it. But then somehow, it was followed up with the Blair Britain and in particular the ability to take advantage of Europe and shift Britain's relative role in the world through leading Europe de facto. So to me, Brexit is the worst policy mistake that Britain has made since going back on gold in 1925, and will have very profound negative economic implications. I mean, it's the old sort of adage, you've chosen your bed, now you need to lie in it. And it's not going to be good. Now, in the very near term, a lot of boomy growth atmosphere because of the success of getting on top of COVID. But that's not going to last, in my view. I think the secular trends will take over in 2022, 23 and beyond. So I'm pretty pessimistic about the UK, I have to say.
Okay, well, that's nice to know. Thanks for that, as someone who lives in London.
Sorry about that. No. The property market in London, I think, has been dependent upon Britain being seen as the place to go. And if Britain's not the place to go, then I worry that that's going to be one of the major casualties over the next few years.
I did want to ask you a few personal questions I like to ask all my guests. Like, one is, you kind of look at a lot of data and presumably you must read around a lot as well. I mean, how do you manage your day-to-day research and information flow? Because it's quite easy to be overwhelmed.
Yeah, I suppose I'm one of these people that's I'm a creature of habit. I was one of the forces helping develop this product called the Global Data Watch at JPMorgan. And, we sort of was in the late 80s. And essentially, every day I started looking at a particular set of data and markets and things. And I've been doing the same thing ever since. And it's a very sad thing to say, but my methodology really hasn't changed very much over the past sort of 30 years. Where I come from, my attitude is to say that we have quite a lot of good economic theory that allows us to sort of model and think about how the world should change. But there's so much uncertainty that we can't be 100% confident either about the inputs to those models or the models themselves. But the one thing we can do with some degree of confidence, if you're honest about it at least, is you can describe where we actually are today. So data watching to me is an integral part of doing good economics, and especially good economics for financial services, for markets, because your ability to project out is very limited. Probability of getting it right is probably well below, not much more than 50%, let's say. But you can get the current conjuncture right. That's not that difficult. It takes time and effort. You have to be on top of things and you have to do it every day. And that's my approach. That's my methodology, which doesn't make for a very lots of long holidays, lying on the beach. But that's what comes of being the sort of kid that buys accountancy made simple when you were 13.
And speaking of books, apart from that accounting book, have there been any other books that have really influenced you in terms of the way you do things?
Well, I suppose in the past year, I read a lot of these, books that people focus in on in the financial industry, these trendy ones and all that. But in the past year, I've been very, very diligent in my reading of Keynes, and in particular, actually the biography of Keynes that I went back and reread the biography of Keynes that Robert Skidelsky wrote over a 3-volume. He wrote it over about 20 years, and I just, the more I read it, the more I look and think about the guy, the more I realize here's a guy who was just so on top of everything, and really shapes my thinking. I'm a true Keynesian, but not in the way that most textbooks would describe a Keynesian, if you see what I mean. Keynes started out as an emerging market economist, which is sort of how I started out. His first book was on Indian currency and finance, But what he was primarily was a guy who developed his theory out of looking at the world and saying, how does it work? Not developing a theory and saying, well, this is how the world must work. And that's one of my big beefs at the moment is I think the policy world has been way too shaped by poor academics who've basically gone in there and said, this is the way the world works and you need to apply this. Not this is actually, and for example, in the last decade, I spent a lot of time very frustrated by the fact that one of the reasons we had such weak growth, especially in the first 5 years of the last expansion, was because we imposed way too much regulatory control on the financial system. We essentially blunted the recovery by taking all the sort of upside of a return of financial optimism out. And that to me was very predictable. But the theoreticians said, it's got nothing to do with that. Higher capital can only be a good thing. If you enforce much higher capital ratios on banks, it can only improve things. And even now, when they had a decade of underperformance and things looking awful, they don't want to accept that the over-regulation early in the expansion could have been something that was a problem. But if you kind of look at Keynes, and you realize this is a guy who was really, really understood behavior, really, really did, understand that human psychology was integral to the way economists perform.
Yep, no, absolutely. Yeah, I'll have to dust off my Skidelsky biographies and reread them. You've motivated me.
Oh, and by the way, it's through the late 30s and into the war, his number one obsession was inflation. And why was he worried about inflation? Well, because he realized as we got back to full employment, inflation was the problem. In a war economy, inflation is always going to be your problem. But this idea that all he was interested in was promoting demand when growth was low, it was true when growth was low and we had massive unemployment. He was definitely in that camp. But when things switched, he was agile enough to switch his thinking, and that's to me the sort of economist we should all be. So I'm sort of doing as much reading of Keynes as I can just to make sure I don't miss a trick.
Yeah, that's great. Good. And now, how can people follow your work? What's the best way of them doing that?
Well, I put out my own work under my own somewhat arrogant name of Suttle Economics. So if people want to read my stuff, they can subscribe to my service, which is basically put out a daily, a weekly, and a monthly, pretty standard sort of investment bank style products, because that's my background. So if you want to reach me, I'm at phil@suttleeconomics.com.
Yeah, I mean, I'll include all the details on the show notes, and I would urge everybody to subscribe to Phil's product. I think it's probably the best economic daily that I think is out there personally. So
really kind of you. Thank you very much for saying that.
Well, on that note, thank you very much, for your insights as usual, and look forward to speaking to you perhaps this time next year. Yeah,
thanks, Bella. Thanks for the chance, and good luck, and safe 2021, the rest of 2021 to you and your family and everyone else out there.
Great.
Take care.
Thanks a lot. Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating and a glowing comment. And let other people know about the show too. We'd really be grateful. Also, sign up to become a member at MacroHive and macrohive.com. We'll be back soon, so tune in then.